There is a disconnect in the Australian commercial property market between leasing demand and investment demand. Investment demand is strong. 2012 was a very busy year for investment, and 2013 has started off very much the same way. Prominent in the market are offshore investors. Offshore investors accounted for about 30% of transactions last year. They seek exposure to the Australian commercial property market because yields are high, they're high by international standards, and they're also high against the underlying bond rate. Australia is attractive to offshore investors because the economy is strong, the market is well regulated and transparent, and yields are high, comparing Australia with many offshore markets, and in addition yields are high compared to the underlying bond rate. Apart from offshore investors, domestic investors are becoming increasingly aggressive in the local market. A-REITs in particular have been repriced and re-rated. Many of them have refinanced their debt, and they are now able to make yield accretive investments in the Australian market. So as we go through 2013, increasingly offshore investors won't have things all their own way. They'll be facing increased competition from domestic investors. While investment demand has been strong, leasing demand has been subdued. During the first quarter of 2013, across the CBD office markets, we recorded negative net absorption of about 91,000 square metres. That's the weakest result since the first quarter of 2009, and before that you've got to go back as far as the fourth quarter of 1991 to find a similar result. The weakness was fairly broad-based. In the case of Perth, a market which is very much driven by the mining sector, we saw a number of major projects put on slow by some of the large mining companies. In the case of Sydney, a financial market-based market, we've seen a slowdown in M&A activity, and some of the investment banks have been giving space back to the market. A number of specific factors drive individual markets. In the case of Brisbane, for example, about half the sublease space that was given back to the market can be explained by downsizing in the public sector. While the weak result in Q1 2013 was, we believe, something of an aberration, nevertheless, we expect that leasing activity will remain subdued through the remainder of 2013. The vacancy rate across CBD office markets jumped from 8.8% at the end of last year to 9.8% currently. We expect that the vacancy will continue to rise, peaking around about 11% towards the end of this year, and will then start to decline gradually and slowly over subsequent years. The saving grace for Australian office markets is the low supply pipeline. Together with high rates of pre-commitment, and we estimate that pre-commitment is between 70 and 75%, we see 2013 as marking the trough in the current office market cycle. Subdued leasing activity is not, of course, confined to office markets. We've observed similar trends across the retail sector and also in the industrial sector. The question is, how do these trends emerge in terms of capital values and also in terms of yields? We've seen yield spreads widening across many markets. For example, right now between the Sydney CBD and the North Sydney office market, the yield spread is 150 basis points. The long-term average has been 100 basis points. In the case of retail, the spread between neighbourhood shopping centres and the large regional centres is the widest it's been since 2002. Going forward, we think that yield spreads will remain wide, and we think that the spread may even widen further. On the one hand, there's a thirst for trophy assets on the part of offshore investors and increasingly aggressive domestic investors. On the other hand, risk aversion remains high, and we think at the other end of the scale, older assets and less preferred locations will have downward pressure on values and correspondingly upward pressure on yields. The retail sector probably deserves special mention. In recent years, it's been a sector under pressure because retail spending growth has been running well below trend. Consumer confidence has been quite fragile. However, we're now starting to see green shoots emerge. The household balance sheet is looking much better, thanks to stabilisation of house prices and a recovery in the share market. Jobs growth remains relatively strong, wages are growing. So it may well be the case that through 2013, the retail sector is a sector that's showing strong signs of recovery. So what does the remainder of 2013 hold for tenants, for landlords and for investors? We believe one of the key questions for all participants in the market is to decide what are transient changes and what are permanent or structural shifts. Over the next 12 months, we expect to see continued yield compression in the case of premium grade assets, and in other sectors which are less preferred, it may well be that we see values start to emerge. Examples of this are neighbourhood shopping centres, non-CBD markets, and within the retail sector, for example, the bulky goods sector seems to offer value. Finally, there are, of course, as always, some wild cards. Through the remainder of 2013, one of these could well be the exchange rate. The Australian dollar has remained remarkably strong in recent years, but in the last few months we've seen weakening terms of trade, and the question is how that plays out in terms of foreign currency. The other big question is how the economy transforms itself from relying on mining investment to other sectors of the economy, such as the residential construction sector. Clearly, this is going to be one of the big questions over the remainder of 2013, and it has implications not just for the real estate sector, but also for locations, for states like Western Australia, New South Wales and Victoria. Whatever else happens over the remainder of this year, we can be sure that 2013 will prove to be a most interesting year. This is David Rees, Head of Research at Jones Lang LaSalle, Australia.